All right, let's step away from that and focus on a report that CRISIL has just put out. And to help us understand that a little better, we've got Mukesh Agarwal, who's president of CRISIL Research, joining us now from Kolkata. Mukesh, to begin with, this report that you've put out, could you briefly take us through the key findings of the report on corporate revenue growth and profitability that you say is hitting a 6-quarter low? Tell us what the main reasons for this projection you've made are.
Hi George, we have analyzed the performance of 247 companies across 26 sectors, and these 247 companies account for about 65% of the market cap of NSE 500 companies, excluding oil and banking sector. And we have 4 key findings. First is the revenue growth in the first quarter is expected to be around 14%, which is the lowest in the last 6 quarters. And this is mainly due to slowdown in demand due to persistent high inflation, high interest rates, and given the economic uncertainty. And the second finding is on the profit margins at the EBITDA level. On a quarter-on-quarter basis, we expect the margins to remain flat, wherein if you compare flat at around 19 to 20%, but on a year-on-year basis, we expect the margins to decline by around 100 to 150 basis points. This is mainly again because of rising interest costs and input costs. The third finding is we are seeing a deceleration in the investment cycle. The capex growth in capex at 13% in the fiscal 12 was the lowest in the last 5 years. And the last finding is because of the rising interest rates, interest coverage ratio, which basically indicates the ability of a company to pay the interest and finance charges, was the lowest in the last 3 years. So these are the key findings of our recent study, which we do every quarter.
Hi Mukesh, afternoon. So you certainly painted a fairly bleak picture. In light of this, tell us which sectors you believe over the next 6 quarters, are expected to be hit the worst, and which sectors you think will perform well.
Yeah, if you look at the sectors which are likely to do well, we would say mainly the 2 sectors, which one is IT and other one is pharma. And this will be mainly supported by the rupee depreciation, and pharma again will be supported by the growth in exports. And the sectors which we expect will see a slowdown in the growth are sectors like hotels, airlines, shipping, commercial vehicles, real estate, construction. These are the few sectors wherein we expect there will be some slowdown in the revenue growth, and also we expect some contraction in margins in the sectors. These are the few sectors.
Right. Also, Mukesh, your report points to a sharp deceleration in the investment cycle, which you say has dropped to a 5-year low. Could you elaborate on that?
Yeah, what we have done is we have looked at the gross fixed asset formation of the companies which we have analyzed over the last 5 years, and the capex growth in the last fiscal was at 13%, which is the lowest in the last 5 years. Even post-Lehman crisis, the growth in capex was higher. And this is also supported by the fact that we also analyzed depreciation as a percentage of sales, which was at around 4.5% in the last quarter of fiscal 12, that is Q4 of fiscal 12, at around 4.5%, which is the lowest in the last 10 years. And we don't expect the investment cycle to pick up immediately. This is mainly because of one is economic uncertainty, the flux in Eurozone. Then we don't expect the interest rates to moderate in the near future. And plus, given the policy logjam and issues related to project clearance and land acquisition, etc.
Right. So Mukesh, just staying with that point that you made about fixed asset creation in India, you've pointed out 2 broad reasons for this having slowed. One, of course, the global environment, and the second, the domestic environment where interest rates continue to remain high. There continues to be policy paralysis and all those issues. Between the two, the global environment and the domestic challenges, which to your mind is the bigger concern?
I would say the domestic reason, the policy logjam and the higher interest rates would be a bigger concern, because if you look at GDP is to a larger extent supported by the domestic consumption. So domestic issues would play a larger role over here.
And as part of your findings, you did mention interest costs that will surge for India Inc. But give us an analysis as to how big an issue will interest rates be for corporates, and how much of a drag will this be on companies?
The interest rates, if you look at what we are saying, that interest coverage ratio is at the 3-year low, which is at around 5 times. But still, it is not a concern, because if you look at the debt equity ratio, which is generally called as gearing of all this 247 companies which we have analyzed, is still at around 0.5 times, which we are talking as a gross debt. If you exclude the cash in hand, the gearing will be further lower. So gearing levels are not a concern. Even the interest coverage ratio is 5 times is a comfort. But again, it will vary from sector to sector. If you look at sectors which have high gearing and poor cash flow sectors, this will include sectors like textiles, shipping, airlines, construction. So these are the sectors which have high gearing or high borrowings and weak cash flows. They will be under stress. And we also feel that the impact of high interest rates will have on interest rate sensitive sectors like automobile and real estate, because there the demand is clearly linked to the interest rates. And our fact is also supported by that. If sometime back CRISIL had come out with our ratings roundup, which is rating actions in the fiscal 12. So we had seen that the default rates have reached a 10-year high of 3.4% in the fiscal 12. And plus, we have also come out with a study which shows that we expect the restructured assets to be around 2 lakh crores in the fiscal 12 and fiscal 13. And this will take up the restructured assets to be around 3.5% of the sectors outstanding.
Right, and Mukesh, also you've said that while margins will broadly be under pressure, the ones that will be able to protect margins are the ones that are export oriented. Yeah, you've talked about the IT and IT services industry as an example. Now, when you say that these companies can protect their margins, can we assume that the global environment is not as bleak as we're making it out to be? And again, goes to the second part of the question, where the government has constantly blamed the global environment for the country's problems. Do you think that is a little overblown?
See, if you look at the export-oriented sectors, one of the key reasons why their margins will be protected is mainly because of rupee depreciation. Rupee till now has depreciated by around 7% in the first quarter this year. If you look at, I have mentioned two sectors. So if you look at IT sector, we expect the growth to be around 25% year-on-year demand growth. That is in terms of rupee, and quarter-on-quarter it will be around 4%. But if you look at the dollar terms, the revenue growth year-on-year will be around 9 to 10%. So it is having some impact on the demand growth even for this export-oriented sector. But one of the major beneficiaries for these sectors would be the sharp depreciation in the rupee.
Many thanks, Mukesh, for joining in and giving us a detailed perspective of that interesting report made out by CRISIL on the Q1 earnings outlook.